In the March 2000 dot-com crash, one market high-flyer saw its share price collapse from $2,600 to $500 in a single year. While the left chart shows an 80% price collapse, the internal ledger told a different story. Income grew 50% and net profit climbed 20%. Price and business performance moved in opposite directions, proving the market can detach completely from mathematical reality. Analyzing this disconnect requires a shift in perspective. A stock represents a legally binding fractional ownership claim on a living business. Benjamin Graham personified the source of these erratic price quotes as Mr. Market, a manic-depressive partner who offers to buy your interest or sell you his every day, based entirely on his current emotional state. Because human sentiment drives these daily offers, the market price of an asset and the intrinsic value of the underlying business operate as independent variables. Modern portfolio theory and staid academic finance operate on a core premise. Risk is defined as the historical volatility of an asset's price. This logic is best viewed through a game of chance. If you are offered $10,000 to survive one chamber in a game of Russian roulette, you are accepting a 16.7% risk of total ruin. To scale the potential reward to $100,000, academic theory suggests you must accept a higher degree of risk, in this case adding a second bullet and doubling the probability of disaster to 33.3%. Graham's research challenges this relationship, suggesting that in the context of intelligent investing, the link between higher rewards and higher risk is far more fragile than the Academy claims. Benjamin Graham himself provided the precise mathematical tools needed to dismantle this assumption. In his framework, risk is measured by the premium paid over an asset's intrinsic value, rather than how much the price fluctuates on a screen. To exploit the market's irrationality, an investor must first calculate a baseline value for the business that exists independently of its stock price. Graham's formula for this baseline involves multiplying normal earnings by 8.5, then adding 2 times the expected annual growth rate for the coming decade. Reversing these variables allows an investor to audit the market's current expectations. By plugging in the market price, you can see exactly how much growth Mr. Market is assuming a company will achieve. Data from 2018 illustrates the utility of this audit. Amazon's price required a 74% annual growth rate to be considered rational, while Apple's price assumed a growth rate of only 5.8%. Once an intrinsic value is established, Graham applies the margin of safety. This rule forbids paying the full calculated value, suggesting a purchase price no higher than 2/3 of that number. Think of it as an engineering requirement. A ship intended to carry 30 Vikings is engineered to withstand the weight of far more, ensuring the vessel survives calculation errors or unexpected conditions. This engineered buffer is what gives a valuation its utility, providing a structural defense against the inherent risk of being wrong. In Graham's time, Mr. Market arrived once a day with the morning newspaper. Avoiding his emotional swings was a simple matter of ignoring the financial section. To counter today's constant stream of digital quotes, the defensive investor, who has limited time for analysis, must rely on strict quantitative hurdles to prevent emotional decision-making. These filters prioritize stability. A company must generate at least $700 million in annual sales, maintain a 20-year dividend history, and show no earnings deficits over the last 10 years. The valuation ceilings are equally rigid. The price-to-earnings ratio must stay below 15, and the price-to-net asset value cannot exceed 1.5. To gauge financial health, Graham insists on a current ratio of at least 200. This active strategy typically avoids glamorous growth stocks because their valuations depend on future projections that are often less reliable than current asset values. Graham directs these investors toward an extreme anomaly: companies trading below their net working capital. Net working capital is defined as the current assets remaining after subtracting all of the company's total liabilities. If the market price falls below this threshold, the investor is essentially buying the business for less than its liquid cash value, effectively getting all fixed assets, like land and machinery, for zero cost. Market-beating returns are generated by hunting in these zones of maximum pessimism, where emotional distress causes the market to ignore tangible, liquid assets. This evidence brings us back to the academic claim that higher potential rewards require accepting higher price volatility. Graham's data inverts this. Imagine buying $1 of intrinsic business value for 60 cents. As the market panics and the price drops to 40 cents, this widens the margin of safety, lowering risk while simultaneously increasing potential reward. This inversion of risk and reward is the common thread among the most successful investment track records of the last century. The intelligent investor recognizes that price and value are not the same. They understand that risk is determined by the price paid, and reward is a function of the margin of safety they engineer.